Well, welcome to the lecture today. Today we're going to be talking about market orders, where we want immediate execution at the best available price. That's the only order that has no contingency, no qualifier. I'm more interested in execution than I am price. We'll talk about limit orders, where I want to do business, but I want to do it at my price or better. Nobody has to do business with you at your price or better, so that order may or may not ever be filled. And then we're going to talk about stop orders. Stop orders are used to stop losses. That's the number one use. That's why they're called stop orders, stop the loss. But there's other uses we'll be looking at. We'll be looking at how to use a stop to not only stop a loss, but protect a profit. We'll also be using it to establish a stock position. So, that will be today's discussion. Market orders exist outside of the securities industry. Market orders exist outside the securities industry. I was at the airport waiting on a flight to Denver. I need to be in Denver next day. Got to be on the Schwab campus in Lone Tree, Colorado. And as I'm looking at the screen, all of a sudden the flights just disappeared. My flight was canceled. So I just looked at the flight screen. I looked at the next one that was going to Denver. In fact, I would even take Colorado Springs if that's available, but it was a Delta flight. And I went up to the ticket counter. I said, I'm your dream customer. I need to have my butt on that plane. And, they said, well, the price, I said, doesn't matter what the price is. I need to be on that plane. So those exist outside the securities industry. I used to have board meetings in Chicago in June in the 90s. And in the 90s in Chicago, you could rest assured that the Bulls would be playing for another ring. And so, I called up a ticket guy and said, listen, I want to go to the Bulls game, NBA championship. I'm more interested in execution than I am price. My friend said, well, Dean, I want to go, but I'll go for $2,000 or less. I said, well, that's a limit order. You may or may not be at the Bulls game this evening because you're telling me that the price is more important than the execution. So, we'll be talking about those various examples. Now, the two positions we can have at a brokerage firm or long or short. We can be long or short an option. That was an earlier discussion. That was lecture 1. I refer you back to lecture 1 on introduction and nomenclature of options. Today, we're talking about stocks, but whether you want to have a long option position or a long stock position, very testable, you need to do an opening purchase. This is very much an answer set that you're going to encounter on your exam. Definitely SIE, definitely Series 7 top off, perhaps not on a 65. But they'll say, which of the following orders would be used to establish or add to a long position? And you would say opening purchase. And the other version of this on your exam, they'll say which of the following would be used to establish or add to a short position. On every order ticket, there's 4 boxes: opening, closing, purchase, and sales. And so we got to be able to tell you what you do. I think a good analogy would be if you come out to Vegas to the casino, the way you establish your position within the casino floor is to go to cage if you really want to sound like a player and say, I'd like to do an opening purchase. You want to buy some chips, right? And then when you're all done, you go back to the cage and say, I'd like to do a closing sale. So closing sales are used to offset or reduce or eliminate a long stock position, and closing purchase is how we eliminate a short position. I can't imagine any draw in which you're not going to see this answer set. And somehow, some form, you're going to see that answer set. And, it's more about the answer sets, not so much about the questions. So, people say, hey, Dean, do you know what's on the test? I say, well, I have helped a lot of people through this exam. I perhaps know more than most about the kind of challenges you're going to get. But I said, it's not so much about the questions on the exam. It's more about the answer sets, because they're very good at distractors, which are wrong answers. All of these could have been a right answer. So it depends on what they're asking you, depends on which one of these are the answers. So, that makes the test a little more, harder because, the distractors, that's the technical name for wrong answers, could be right answers to different questions. So let's just go through this. If on your exam, they said, which of the following would be used to establish or add to a long position, you would say A. If they said, which of the following would be used to establish or add to a short position, you'd say B. If they said, which of the following would be used to eliminate or reduce a long position, you would say C. If they said, which of the following would be used to eliminate or reduce means, by the way, what we mean by that is if you're short 1,000 shares of SeaWorld, you can buy back 500. You don't have to get rid of all of it if you don't want to. If they say which of the following would be used to eliminate, offset, or reduce a short position, you would say D. So, that's very much an answer set that I'd be prepared to encounter on your exam. All right, well, as we said, market orders, you want immediate execution at the best available price. This is the only order on your exam that has no contingency, no qualifier. I say, listen, I just want to buy 1,000. Let's say that Apple's at 128 today. I call my broker, or, if I'm trading online, I say buy 1,000 Apple at the market. So I would assuming there's no gap in the marketplace, that I'm going to pay something around 128. But if by the time the order hits, it's 128 and a half or 129, I want execution. So execution is more important than price. As I said, it's the only order that has no qualifier, no contingency. All the other orders we're going to be discussing in this lecture have some kind of a qualifier or a contingency. So now you're saying you want your price or better. Every once in a while in the office, we'd have a very good day. And my brokers would say, Dean, are you buying the office lunch? I say, I'm buying the office lunch on a limit order of $1,000. If we cannot feed this office for $1,000 or less, I'm not good for it. Now, one of my brokers came back and said, Dean, we got it done for 800. There's an implied or better. That would be fantastic, right? That would be better. If they come back and say, Dean, it came in at 1,200. I said, well, I'm only good for 1,000. I'm not good for 1,200. Test point. An error in execution. If a customer gives me a limit order and there's an error in execution, in other words, you told me to buy 1,000 shares of Apple at 127, and it goes off at 127 and a half, that's on the broker dealer. The broker dealer is liable for that. Now, on the other hand, if you told me to buy 1,000 shares of Apple at 127, and I told you got it at 126.95, and you're a happy camper, but then I call you back and say, hey, I'm sorry about that. That report was wrong. You bought it at 127. So an error in report, the customer is still obligated. Now, if that happens too often, that customer may want to look at getting a new broker, but error in execution, broker dealer is liable. Error in report, the client is liable. It has to make good, basically, what we're saying there. So as I said, buy limits are always placed below the market. It kind of makes sense if we put down here the current market price of Apple. I'll just make it up. And let's say it's 128. It'd be foolish with Apple at 128 to tell me that you want to buy it at 120. It'd be foolish for you to tell me that you want to buy that at 130 when the stock is at 128. I'd say, listen, you must be new. I'll fill you. If you say, Dean, I want to buy it at 130 with the stock at 128, I say, you just bought Apple at 130. And I'll buy it at 128 and I'll fill you at 130. I'll make 2 points, and that beats working for a living. So very testable that we place buy limits below the current market price. And that is very, very much a test issue. Sell limits are the opposite, right? It'd be very foolish for you right now with Apple at 128 to tell me that you want to sell it at 126. I'd say, well, you must be new. I'm here for you. Want to sell it at 126? I'll buy it from you at 126 and turn around and sell it at 128. Make 2 points. It beats doing lectures on Series 7 for a living, right? So very testable. Sell limits are placed above the current market price. And remember, the whole point here is the customer is saying that their price is more important than execution. So you may or may not get execution. Now, all of these orders are considered day orders. That too is testable, unless we say something differently. So, you put in a buy limit to buy Apple at 127 when Apple's at 128. Now, what you're trying to do here is get the Apple less than the current market price. And, I call you the next day. I say, hey, you're limited to go off. Do you want to re-enter? He goes, yeah, let's put it back in there. And I said, okay, cool. By the way, the test still assumes that we're full service brokers or investment advisor representatives. And, we talk to people, real people talking to each other, outside of your series SIE and Series 7 and 65 Fantasyland, that may not be good, may not be true. But anyways, I call you the third day, doesn't go off, the fourth day. You say, Dean, why do you keep bothering me? I said, well, all your orders are considered day orders unless you tell me differently. Would you like me to make that GTC? Good, tell, cancel. And you say, well, yeah, let's just make it good, tell, cancel. I say, okay, so I won't be bothering you anymore. You're telling me that anytime good, tell, cancel, we can buy Apple for 127 or less, please do so. Say, fantastic. Now, most systems, this is Apple's a NASDAQ stock, but in New York, we have a guy called a designated market maker. And whether it's the designated market maker with his order book, which we'll talk about later, or whether it's the firm's internal standards that's keeping track of this, we usually tell you that we're going to clean up the order book in April and October. So we remind you on your statements, the open orders you have with us. And we tell you that if we, don't properly renew those in April and October, we're going to go ahead and remove those from the order book. Examples of market orders and limit orders. I left a question mark here on Apple. And the reason I left this question mark is because I would like you to be able on your exam, I would like you to be able to intuit what Apple is at. If we're looking here, there's no issue here because you just want to buy Apple at the market, best available price. Remember, there's only two orders. I think a lot of people get hung up. They think there's a zillion types of orders. There's not. There's only market orders and limit orders. Now, granted, there are a zillion contingency or qualifiers you can add to the order. But, at the end of the day, it's either a market order or limit order. I think it's the same thing gets people hung up on general obligation bonds and revenue bonds. People think there's a zillion type of municipal bonds. There's not. There's just GO bonds, general obligation bonds, and revenue bonds. Now, granted, within those categories, GO and revenue, there's a zillion subcategories. But at the end of the day, it's either a GO or revenue. Same thing here. It's either a market order or limit order. Now, the reason I left this blank here is because we're looking at a buy limit at 125, and we're looking at a sell limit at 130. And so what I want you to be able to do in your exam is intuit that Apple must be somewhere between 125 and 130. As I told you, Apple was at 128. And so I would like you to be able to intuit that. Now, how did Dean intuit that by the way, I don't have to be able to say it's 128. Who knows if it's 128? It's just somewhere in between those, right? So if I'm looking at a sell limit at 130 and a buy limit at 125, based on knowing, which I'm supposed to know, I'm held accountable to know, that it's somewhere in between there, you should be able to tell me the current market price is somewhere in there, right? So you don't have to come up with 128, but based on where these orders are placed, you need to, can say, well, it's got to be because a buy limit's below and a sell limit's above the current market price of the stock. CMP means current market price. It's got to be somewhere in there. Let's just say Apple is trading at 128. Remember, the whole point is you'll always accept something better. So you'll be pleasantly surprised if I call you and I say, hey, your sell limit, you sold it at 131 or you bought it at 124. So there's always an implied or better in a limit order. Stop orders, very important, are used to stop a loss. As we said, that's the number one reason to use a stop order, and that's why they're called stop losses. I had been cold calling this guy in this country club for quite a while. It was back in the days when Dean was a baby broker, and I had called him and I said, listen, what I'd like you to do is open a new account with me and buy 1,000 shares at 50. That's $50,000. If I'm right over the next 12 to 18 months, I think this could be a $100 stock. And that would be, a $50,000 gain over the next 12 to 18 months if I'm right about this stock. I said, but I could just as easily be wrong. And so with your permission, what I'd like to do is after I open the new account and buy you 1,000 shares at 50, I'd like to place a sell stop at 47. And that way, if it trades at or through 47, the stock will pull the trigger, turn into a live market order and send you home. So if I'm wrong, you're going to lose approximately $3,000. Anyways, the guy started cracking up and he said, honey, there's a broker on the phone, says it's going to cost $3,000 to get to know him. What do you think? Yeah, I hear her in the background. He said, Dean, you're one of the few brokers who ever told me what's going to cost if they're wrong. Like he says, part of successful investing is letting your investment flowers bloom, but more important, pulling your investment weeds. He said, I like stop orders because they're automatic weed pullers. Most brokers who cold call me like you've been doing usually tell me, what's going to happen if they're right, but not what if they're wrong. And if they're right, they call me every day and ask who else do they know that I can make wealthy. When it goes down, I guess they think I can't see it. And they finally wait till it's like 25 and try and get the media average into the dust. He said, so tell you what, young man, in those days, I was a young man, not so much anymore. He said, so young man, go ahead and open that new account, buy 1,000 shares at 50, place the sell stop at 47. If that sell stop gets triggered and becomes a live order, if it becomes elected, well, you can tell this is not his first rodeo. He knows these types of orders. Anyways, he said, if it gets triggered, close the account, send me a check. The relationship is over. It was one of my best days ever as a broker, baby broker, because, by the way, baby broker is not a derogatory term. That's a term of endearment. Anyways, as a baby broker, is one of my best days ever. As I opened 9 accounts out of that country club. They started calling the reception desk and saying, hey, could they talk to the $3,000 broker? I finally gave up and said, yep, that's me. Now, good news, we got lucky and the stock went up. And so when I called him and I said, hey, listen, we don't need to stop a loss anymore. What we really need to do is protect a profit. So what I'd like to do is move up our sell stop to protect that profit. And I'm going to show you all the uses of these, by the way, very testable. So I'm going to show you every use of these. We're going to do, an example of each and every one of these. You can also use this to establish a stock position. I had a good friend of mine. She called me and she said, Dean, my husband is making me nervous. He's recently put our retirement plan online at Schwab, and he's playing video arcade games with our, retirement money. Could you please give him a call and see what he's up to? I said, yeah, no problem. I reached out. I said, hey, Mark, Dean here. You're making your wife a little nervous. What's up? He said, well, Dean, I've been watching this stock and it used to be a $40 stock. And I said, well, Mark, there's probably a reason why it was a $40 stock. He says, now, Dean, it's a $10 stock. So I'm thinking about buying 1,000 shares at 10 in my retirement plan. If it goes back to 40, I'm going to make $30,000. I said, well, now, Mark, that's a big if. I mean, that may or may not ever go back to 40. And if you take a loss in your retirement plan, that's a real sin. I mean, the two major impediments to investment success, Mark, are taxation and inflation. And in your retirement plan, you've already beat taxation. So if you can just get ahead, you're doing fine. So I would recommend you put that into your personal account, because at least if you're wrong in your personal account, Mark, you can deduct up to $3,000. Anyways, he said, well, Dean, I don't think it's any of your damn business, but I don't have the money in my personal account. I said, well, that's probably not a good reason to be day trading your retirement plan. Oh, well. I said, Mark, while we've been talking, I brought up a chart on the stock, and it looks like it's kind of stuck at $10. I mean, why would you want to get on board the train when it's stuck in the station? You really only want to get on board the train when it leaves the station going your way. What I might suggest, Mark, is call Schwab and put in a buy stop at 12. Tell Schwab that you don't want to buy this stock unless it trades at or through 12. That way you still got your 10 grand earning you interest. And even if it trades at or through 12, maybe you get a bad fill. Who knows? You pay 12 and a half or 13 and it goes to back to 40. Let's say it goes off at the trigger, immediate execution. We'll talk about this at length in just a bit. But anyways, let's say it goes off at 13. Now you make 27 grand instead of 30, but in the meantime, you still got your money. He said, well, can I do that? I said, absolutely. I said, boom. He put in his buy stop at 12. After he put his buy stop in at 12, the stock went 10, 9, 8, 6, 5, 3, 2, bankrupt. Uh-oh, the train left the station going the wrong way. Please note, he never bought the stock, right? Because he said, I only want to get on board that train, that stock, when it leaves the station going my way. And since the stock never traded at or through 12, he never ended up buying the stock. Anyways, he was so excited. He said, Dean, that was so cool. He says, have you ever thought about being a broker? I said, well, I don't know, Mark, what you think I did for 30 years of my life, but he probably should get an investment advisor representative to perhaps help him with his investments. Oh, well. So let's look at some of these positions. Now, before we start looking at these various orders and some testable examples of these things, I just want to give you a heads up that every time you have 3 of a thing, one of the formats they love on the test is the except format. All the following except. So stop orders can be used for all the following except. And this wouldn't be 1, 2, 3 on your exam. It would be ABC. And D would be something that it's not used for. I'll play a snarky customer service rep. I say, oh, I see, Mr. Jones, you're putting in a stop order. You must be, trying to stop a loss, protect a profit, or establish a stock position. He says, well, no, I'm not. I said, well, then you're confused. I mean, that's what's going on here. All right, so let's look at some examples of this. So stop orders are suspended or contingent orders. They can either become live market orders or live limit orders. They have a contingency. So we're going to pull the trigger, 2 separate events, by the way, and they may never become live. If I show you a sequence of trades on the exam, one of the potential answers is it never got elected or never became a live order, right? So here, stop orders don't become live until they trade at or through. Be careful. It's not at. It could be at or through. I mean, in my example of, maybe I'll put a sell stop on Apple at 127. You know, if it trades at 127 or 126.99, it becomes triggered. You know, so it's at or through. There's no way in a number line to go from, you know, 127.05 to 126.99 without trading through. I'm going to give you examples of that at length in just a little bit. I can't tell you how many people get confused about this, even customers. So, you know, I'm watching CNBC. On the bottom of CNBC, there's a tape going by. I'm watching the sequence of trades. And I can't tell you how many customers in the past have called me and said, oh, there's my order. I say, no, that is not your order. That is not your order. That is the order that turns your suspended order into a live order. Two separate events. That's what a lot of people get hung up on, including customers. By the way, anything customers get confused about is very, very testable for you on your 7 SIE or 65, because you're the one who's not supposed to be confused. So we're going to go through these things, and we're going to see that it's two separate events. All right, so let's look at some examples of this. The first examples I'm going to show you is we're going to use a sell stop to stop a loss in a long stock position. I'm going to show that to you. I'm going to show you how to use a sell stop to protect a profit in a long stock position. And then I'm going to show you how to use a sell stop to establish a short stock position if the stock trades at or through the support line. So, you know, technical analyst, technical practitioner like stop orders too. As I kind of hinted, they don't like getting on board the train unless the train leaves the station going their way. And so I'm going to wait for it to trade at or through before I actually, you know, get on board the train, so to speak. All right, so let's look at an example of a sell stop order. Let's put this in test phraseology. A customer buys 1,000 shares of Apple at 128. Please note, very testable to know that sell stops are always placed below the market. Very important to know they're always placed below the market. So, you know, I'm following the convention here. So let's look at the convention. I bought 1,000 shares of Apple, and indeed I placed my sell stop below the current market price. It is very much a test issue that it's going to be placed below the current market price. And then on the exam, they say something like the following trades then occur. The following trades then occur. So we're going to be looking for a sequence of trades, and we're going to see if it ever trades at or through 124. Because if it does, then it becomes a live, in this case, market order. So you can either have a stop order, a suspended market order, a suspended market order, or a suspended limit order. I'm showing you a suspended or contingent market order. I'm telling my broker, if Apple trades at or through 124, then I want to sell. Pull the trigger, make it a market order. So the first trade after I do this is 127. Nothing happens. You know, and typically on your exam, maybe they'll label these trades, and, you know, they'll ask you to recognize, did this ever become a live order or not? And so first trade 127, it's still a suspended or contingent order because it doesn't become a live order until it trades at or through 124. Then I'm saying pull the trigger, elect. It's not elected until that happens, right? It's a contingent event until it happens. 126, nothing happens. 125, nothing happens. 124 and 05, nothing happens. Ding, 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 ding. On a number line, there's no way to go from 124.05 to 123.95 without trading through 124. Two separate events. This is what triggered the order. Be very careful on the test. That's the trigger. Now, I didn't put another trade in here because it doesn't matter what trade 6 is. It doesn't matter what trade 6 is. It's the customer's trade. If that's 125, it's his trade. If that's 123, that's his trade. It doesn't matter what that trade is. It's the customer's trade because he wants immediate execution at the best available price. So you would tell me on your exam that the order became live on trade 5, and whatever trade 6 is, that's his trade. I know a lot of times, depending on, your study materials that you're using, a lot of times what they'll do in your study materials is they'll put a question mark here. And what we mean by a question mark is, we don't know what that trade is. Now, if you're worried about that, if you're worried about a gap in a marketplace, for example, if you're worried that, the next trade gets triggered and the next trade they halt trading in Apple and the next trade is, 110, that's your trade. If you're worried about that, there is another strategy to protect a long stock position. Here we're long 1,000 shares of Apple at 128. And do you recall from lecture 3, there's 4 option lectures. I highly recommend you do them sequential order, but the second option lecture, or excuse me, the third option lecture was a alternative to this sell stop. And so another thing you might want to consider doing is buying a put, establishing the choice to sell. So, in fact, that's important enough. Let me get out my text box and put that in text for you. So another way to take care of this thing is to buy a put and establish the choice to sell. The disadvantage of buying the put is that, you have to be approved for options, you have to pay a premium, you can't move it around. But the advantage is you have guaranteed execution at the strike price. Guaranteed execution at the strike price. Right? So, 2 arrows in your quiver, about what you want to do. Personally, what Dean thinks isn't testable, but, the good news about a sell stop is it doesn't cost me anything to place this and I can move around. So in my trading practices, I usually place a sell stop out of the gate. And then once I have a profit, perhaps, then I use some of that paper profit to marry my put to my stock position. One other point here, let's just go back real quickly. Let me clean up this slide. In this limit order that we were talking about, I just want to go back on this limit order we were talking about. And, in the limit order, you're trying to get that stock, that buy limit below the current market price, right? So you're putting the buy limit here and Apple's at 128. And remember, there's another way, option way to get the stock at less than the current market price. So you say, Dean, I want to buy Apple at 125 or less. I said, well, why not get paid to do something you're already prepared to do? Another way to get the stock at less than the current market price is to sell a put, right? If you sell a put on Apple, you sell the 130 puts for 7, and somebody sticks the stock to you, you'd be buying Apple at 123. So, another alternative to a buy limit. In fact, let's just go ahead and clean up that slide. Let's put that in a text box for you as well. Another way to potentially buy, because they neither one may end up getting you the stock because it depends what happens. To get the stock, it looks like it's taking me off the screen here. Let me just want to give myself plenty of room to get that there. Another way to potentially get the stock at less than the current market price is to sell a put. Any strategy that Mr. Buffett is a fan of is probably not a bad one. Mr. Buffett loves to sell puts on stocks he's willing to own. And if you stick him the stock, he says, well, thanks another way. Thanks. I wanted the stock anyways. So, orders and options have some commonality here in terms of what we're talking about. All right, back to where we were before. I wanted to remind you about things you can do with sell stops. We're looking at this sequence here, and I just want to go back and show you that limit order. So very much a test question here. We're using it to stop a loss. So let's just review this one. A customer buys 1,000 shares of Apple at 128 and places a sell stop at 124. The following transactions then occur. The following trades then occur. So let's erase that. And we say, let me get this. And what remember you're trying to do on the test is tell me, when does it ever become a live order? And then remember, one of your choices is it may never become live. So we're watching CNBC, or the customer's watching CNBC. The following trades go by. Nothing happens there. Nothing happens there. And as I mentioned, these would typically on your exam be labeled in the sequence. By the way, I got 5 here, but it could, very well, go on further than that. Remember, it's a potential answer that we never see a trade at or through. So nothing happens here. Nothing happens here. Ding, 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 ding. On a number line, boom. Now we have a live order. It doesn't matter what trade 6 is, it's his trade. If it's 124.01 or 125, it's the customer's trade. All right, let's do another one. So this one, we remember we were trying to stop a loss, but we said another use is to protect a profit. So here's another test scenario, right? A customer buys 1,000 shares of Apple at 128. Apple is now trading 187. Woohoo! And now we're trying to protect our profit. So the customer places a sell stop at 185. I'm telling my broker, if the stock trades at or through 185, pull the trigger, send me home. If this, then that. There's a contingency or qualifier here. There's one contingency, one qualifier. If Apple trades at or through 185, pull the trigger, it becomes a live order. So then again, what we're required to do on the test is go through these transactions and see if perhaps does the order ever become a live market order. Now, remember, one of the choices is it may not ever become a live market order. So we're going to show you a sequence of trades. And, then you got to figure out what happened. All right, so let's look at the sequence here. We're trying to protect the profit. And so we're looking for a trade at or through 185. Please note, we followed the convention. Very testable. We placed our sell stop below the current market price. That's very testable. The following trades then occur. I'm looking for a trade at or through 185. So again, I have a lot of customers who will be watching CNBC. CNBC has the tape on the bottom and it shows you the trades. That's called the tape in sequence. So we're watching these trades go by in sequence and we're trying to figure out if it's ever become a live order. We probably shouldn't have forgot to cancel our other sell stop, right? So we cancel the previous one and we'll move it up to protect the profit. Nothing happens there. Nothing happens there. Nothing happens there. Now, again, customers get hung up on this. Two separate events. That is not my customer's order. That is not my customer's execution. No, that's what now has triggered this order. And now it is a live market order. It doesn't matter what that next trade is. It's my customer's trade. Maybe the trade is 188. Woohoo. It gaps back up. Not likely, and there we protected our profit because remember, we bought the Apple at 128. So 188 is we protected a $60,000 profit. And so pretty cool. By the way, we could have also, remember, bought a put to protect this thing. So that would be another thing we could have done. So very much a test issue. So we said stop orders. We have two versions of this, by the way. We have sell stops and buy stops. Right now I'm showing you sell stops. And so we've used a sell stop thus far to stop a loss. Now we're using a sell stop to protect a profit. And so let's look at our next one. By the way, please note in this example, it traded at, and remember it's at or through. And so that's cool too. Whoop, excuse me. That's cool. Whoop. I don't know why sometimes my at or through. So this one, they didn't trade through our trigger to pull the trigger. It traded at. So at or through, and then two separate events. All right, here's an example of a technical analyst. So the technical analyst is looking at a chart on Apple. Let's talk about a chart. Let me get and here's our chart on Apple. By the way, on your test, it's the only time the charts will look exactly how they're supposed to look. And so here's price, and Apple's trading in this trading range. As we said, as a technical practitioner, I do not want to, buy the stock that's not moving. This is time going this way. So time this way, and this is price going this way. And as a technical practitioner, I don't want to get on board the train unless it leaves the station going my way. And so what I'm interested in is if it trades through there, then I say, okay, I want to sell it short. I don't want to sell short until trades are through. I can't tell you how many times I've regretted not placing a sell stop to establish the short position, because what's neat about a sell stop to establish the short position, if the stock moves against me and it goes the wrong way, I never got the short position. I can just keep moving that sell stop up, because what goes up someday must come down, right? So, I'm saying, again, this is kind of the version of my cousin, the guy, or, the guy who doesn't want to, get on board the train until it leaves the station. Anyway, so what order would I place? I'd say, well, let me pull a sell stop here at 188. And I tell my broker, if Apple trades through, 118, 118, pull the trigger and sell the stock. He said, well, Dean, you don't own the stock. I say, I know I don't own the stock. That's the point. I don't own the stock. I want to sell it short. So let's put this in test phraseology. A technical analyst is looking at a chart of the trading history of Apple. The chart shows Apple to have resistance. Test question. That's the upper line. At 130 and has support at 120. It's the only time, by the way, the charts are going to look exactly how they should look. You're not going to be struggling, to figure out, where it's at in terms of this. There's our chart. This is a lecture on types of orders, but the only other chart you're held accountable for in terms of your exam is a head and shoulders pattern, which is a signal reversal. So I'll just give you a heads up on that. Make sure you know that a regular head and shoulders is a signal of reversal from bullish to bearish, and an upside down head and shoulders is a signal of reversal from bearish to bullish. Anyways, I place my sell stop, poof, right? And then I'm to put it at 118. Now, why not these other ones? Well, because this one I wouldn't do because that, can't do that anyways, right? The sell stop has to be below the market, right? And I don't want to do this. I'm trying to go short. So I like that one. By the way, there's a lot of people that have sell stops on Apple, or any stock for that matter, below the support line. Some of them are trying to establish a short position. Some of them maybe bought Apple long ago at 80 and trying to protect their profit, or maybe they're trying to stop a loss. And so test question, sell stops can accelerate bearish trends. Sell stops can accelerate bearish trends. So here's an example of that one, right? A technical analyst is looking at a chart, same kind of question, just a little different turn on it. So there's our 120, there's our 130. That is a resistance. By the way, I'd recommend to you, particularly if you're a Series 7 top-off candidate, on Friday, 2 p.m. Pacific time, that's my time here in Las Vegas, there's a show on CNBC called Options Action. And a great little 30 minutes, great graphics. But one of the things why I'm bringing up now is as part of that show, they have a technical analyst named Carter Braxton. And on the show, sometimes a call to the charts, then he'll show you a chart and he'll tell you about, based on that chart. So as we just said here, a lot of people have these sell stops below. And so if Apple trades right or through that, poof, that will accelerate the bearish trend. It accelerates, it adds more fuel to the fire, right? This one you can't do anyways, and it's not that one, so. Okay, so I showed you every version of a sell stop. And so now I'm going to show you every version of a buy stop. So we have stop orders, and big picture stop orders are used to stop losses, protect profits, establish stock positions. And so now we're going to do a buy stop, and very testable buy stops are placed. Let me get a different color. Above the current market price. That's very testable to know that buy stops are placed above the current market price. We're going to look at how to use a stop loss to stop a loss on a short stock position, how to use it to protect a profit, and how to use it to establish a long stock position. By the way, as I warned you, whenever there's 3 of a thing, they love the except format. So, when I'm doing a lecture and there's a 1, 2, 3 of a thing, then you got to be ready for the except. Like sell stops can be used for all the following except, or buy stops can be used for all the following except. They kind of just love that kind of stuff. So, all right. So now I sold short 1,000 shares of Apple at 128. And I'm smart enough to say, geez, at what point do I want to admit this is a bad idea? How much approximately I'm willing to lose. P.S. Remember, there was an option strategy that you could also use to accomplish this. And so let's just get ourselves a text box and put that there. Do you remember from lecture 3? Another way that you could protect this thing. So let me just put this an alternative way to protect a short stock position is a long call. And again, there's advantages and disadvantages to those. The good news about a call contract is I got guaranteed execution at the strike. The disadvantage, I got to be approved for options. I got to pay a premium. I can't move it around. The advantage to the buy stop I'm about to place is it doesn't cost me anything to place it, and I can move it around. I don't pay any kind of a commission or transaction cost unless it gets triggered. All right, so let's put this in test phraseology. Please note right out of the gate that we did follow the convention. What I mean by following the convention is we did indeed place our buy stop above the current market price. That's very testable to know where we place orders in relationship to the current market price. And please note we did follow that. Now, same kind of a deal on the test. And we're going to show you a sequence of trades. And we're going to ask you, does the order ever become live or not? And remember, it's one of your potential answers to say that the thing never becomes live. It may or may not ever become a live order. So let's put in test phraseology. Customer sells short 1,000 shares of Apple at 128, places a buy stop at 132. The following trades then occur. Anything happen there? No. So we're watching CNBC. We're watching the tape go by. Trades are reported in sequence. And so we're looking at a sequence of trades. Anything happen there? No. Anything happen there? No. Ding, 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 ding. It is no longer a suspended order. Now, in a number line, there's no way to go from 131 to 132.01 without trading through 132. At or through, it becomes a live order. Now, remember, two separate events. Now, here I gave you the trade because I want to show you what you should be able to tell me on the exam. You say, Dean, my customer bought back the Apple at 133. Remember, it's two separate events. The trigger is separate from the execution. Customers get confused about this all the time. Oh, I just saw the Apple trade. I'm watching CNBC, watching Apple trades go by, and I just saw 132.01. That's mine. I go, no, that's not yours. That is the order, the trade that turned your suspended market order into a live market order. Two separate events. So there we're using it to stop a loss on a short stock position, but we said another use would be to protect a profit. So let's look at an example of protecting a profit. So a customer sells short 1,000 shares of Apple at 128. Apple's now trading at 95, so we're looking good. We sold high. We're looking to buy it back low. I want to let it ride, but I want to protect my profit. So I cancel my buy stop at 132 and put my buy stop at 98. Please note, I did follow the convention. My buy stop, very testable. I placed above the current market price. And then again, the following trades then occur. So we're again going through the sequence, and we're trying to see if this ever becomes a live order. And remember, it is potential that it doesn't. So, we're going to look at the sequence of trades. Yeah, this could go on. Can continue to go. And so anything happen at 96? No. Anything happen at 97? No. Anything happen at 97, 95? No. Ding, 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 ding. It didn't trade through, it traded at. That was the trigger. And now we have a live order. And so next trade is ours. Immediate execution at the best available price. So we protected a profit of 29 grand here. So here, two separate events, right? Two separate events. So there we're using it to protect a profit. Remember, the other thing I could have done here is I could have bought a call contract as well. By the way, if this trade was 98.01, that still would have triggered, right? Because at or through becomes a live order. Now, remember, one of your choices on the exam is it may not ever become a live order. I mean, that's a potential answer. All right, so we're looking at buy stops. Again, we're looking at an Apple chart. As I mentioned, it'll be the only time the Apple chart looks exactly what it should look like. I mean, they're not going to try and trick you on what a chart looks like, in terms of this. But, here's our chart of Apple we're looking at. Resistance is that upper line in a chart. And oh boy, it looks like Nina's struggling. Probably should have another cup of coffee before I started this. And support is the bottom line. And we said this is time going this way. time going this way, and price going that way. And then remember what I'm trying to do here is go long only if the stock breaks through. This is the example I gave you with Mark, right? He's saying, I want to do this, but only if it breaks through. So here's the chart, and boom, that's when he wants to establish this position when it trades at or through. So he places his buy stop at boom. And now he is not going long until Apple, he's saying, I want to get on board the train when it leaves the station going my way. So here we're using the buy stop to establish a long position. Now, a lot of people have buy stops above Apple. By the way, it wouldn't be this one because that one may never go off, right? Now, I'd warn you on the test. I'm allowed to use right answers as wrong answers. If I give you two answers and one of them's better than the other, I'm still going to mark you wrong. That is a better answer because that means you're going to get the stock, right? This one may or may not. I'm going to show that to you next. This one, you're saying, once I pull the trigger, I want my price or better. So there's a second qualifier contingency in that. We'll be talking about that at length in just a little bit. Now, right now, for example, though, a lot of people have buy stops on Apple above the current market price. Some of them are trying to stop a loss. Some of them are trying to go long. Some of them have a profit and short position. And so once Apple trades at or through that resistance line, it can cause an acceleration of that bullish trend. Right. So here's another example of a potential test scenario. A technical analyst is looking at a chart of the trading history of Apple. Well, we did that one. He was going to place his buy stop right at 132. But here's another. Oh, I guess I didn't give you that one. Accelerate. There we go. Yeah. Which would accelerate what order might accelerate a bearish trend? Now, I don't like that I asked you a particular order here. I would just know that in general, sell stops accelerate bearish markets and buy stops accelerate bullish markets. I'll fix that in the next thing. I told you I'm relatively new to making PowerPoints and teaching this way. For 30 years, I was an old-fashioned stand and deliver guy with a dry erase board, and I'd show up on campus and teach this stuff with a dry erase board. So it's only since March of last year that I've been making PowerPoint slides and using them, and so my skills are getting better. But I appreciate your patience. As I've said in all these lectures, I will circle back and revise them, at some point. But I didn't want the good to be the enemy, the perfect to be the enemy of the good, and want to be able to post some content for you. So once I get the content up on the channel, then I'll work at fine tuning and coming up with a better slide deck and fine tune some of this stuff. So anyways, that's a big picture issue. All right, so now if you want, this is kind of foolish, but if you want, you say, Dean, when you pull the trigger, I don't want a market order. When you pull the trigger, I want my price or better. I said, well, wow, boy, I think you're being kind of foolish, my friend. Whether Dean thinks you're foolish or not is not a test question, but now you don't have one qualifier. You have now two qualifiers, right? You're saying in our previous examples I was showing you, there was only one qualifier, one contingency, if this, then that. In our previous examples, once we pulled the trigger, it was immediate execution at the best available price. And so it didn't matter what the next trade was, it was the customer's trade. Here we got to be a little more careful because now the next trade may or may not be my customer's trade, because now he's saying when we pull the trigger, he doesn't want a live market order. He wants a live limit order. As you recall, limit order is where he's saying he wants his price or better. And nobody has to do business with you at your price or better. So now we have a scenario which we're looking to see whether it becomes not a live market order, but whether it becomes a live limit order. And that, by the way, very testable. The more contingency or qualifiers you add to an order, the less likely it is to, get executed. I used to have this doctor clients, he'd drive me nuts. He'd give me a buy limit at the close, all or none. And then he'd say, well, did it go off? I felt like saying, well, gee, doctor, you have a half a dozen contingency or qualifiers in there. What do you think? So, all right. So now my customer is saying, Dean, I'm buying 1,000 shares of Apple at 128. And now the customer is saying he wants to put a sell stop limit at 124. So now he's saying he wants his price or better. So now we're going to have to be a little more careful going through the sequence of trades. Very testable. Whether you want a sell stop that turns into a market order, which we looked at previously, or a sell stop that turns into a limit order, where we're looking at presently, it doesn't matter. Sell stops must be placed below the market. So whether it's a sell stop that turns into a market order or a sell stop that turns into a limit order, all sell stops are placed below the market. And please note, we did indeed follow the convention. We follow the convention here because we have here below the current market price. All right, so same deal again. We're going to look at some trades. And what we're looking for is a trade at or through 124. And then we need to know whether the price is acceptable or not. You know, the price may or may not be acceptable to customer, because now he's saying, if we pull the trigger, by the way, it's a potential answer that we never pull the trigger. That's a potential answer. And so let's go through these trades and see if it ever becomes a live limit order. A live limit order. Okay, so anything happen here? No. Anything happen here? No. Anything happen here? No. We're looking for a trade at or through 124. Anything happen here? So we're watching CNBC. Ding, 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 ding. Two separate events. Now we got to be real careful. And the reason we got to be careful is because this is not a live market order. It is a live limit order. And so now we got to be careful, because my customer may or may not accept this next trade. If that next trade is 124, as a seller, he's saying here, as a seller, he wants his price or better, he would accept that, right? But if that trade is 123.99, he would not accept that. If that trade is 121, and then the next trade is 119, that's the part that's foolish. This order doesn't get executed. I mean, I could run this sequence out a whole lot further, right? So this, you got to be a little more careful on your exam. Once we pull the trigger, you got to make sure that you're looking to make sure that it's a trade at his price or better. All right, let's do this again. So a customer buys 1,000 shares of Apple at 128 and places a sell stop limit. Now, if you want, you could have your limit at some different price, and I'll show that to you in a minute, but it's a sell stop limit. By the way, when the customer gives me a price, it's my job to know what that is. So it's not the customer's job to be able to articulate it. What I mean by that is, on the test, if I say your customer wants to buy 1,000 shares at 15, you're supposed to know that's a buy limit. Anyways, here we're looking at a sell stop limit. Following trades then occur. So the sequence of trades, that's the tape. It's called the tape, where we report the sequence of trades. We're looking for a trade at or through 124. And ding, 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 ding. Now we have a live limit order, two separate events. Now, this sequence can continue to go out here. If I label these, this could be 6, 7, 8, 9. And we got to make sure that we're looking for a trade that is his price or better. As a seller, his price or more. So as I mentioned, if this is 121, 120, 119, 118, he never sells this thing. He's got to get his price or better. All right, so that's a sell stop limit. That's a sell stop limit. So let's look at another sell stop limit here. Remember, we got to be a little careful. So sell stop. Now this, I'm showing you here a sell stop where the trigger's at 124 and the limit's 123. Woof. So now we got to be careful. So now what we're going to do, the customer is saying is, Dean, if Apple trades at or through 124, I want to sell, but only if I can get 123 or more. Wow. Following trades then occur. So same deal again. We're going to be looking at a sequence of trades, and we're trying to determine what happens in terms of this. Okay, so again, these would be labeled in terms of the sequence. And so let's go through the sequence and see what happens. So the first trade, please note, we followed the convention again, very testable. Whether you want a sell stop that turns into a market order or a sell stop that turns into a limit order, sell stops must be placed below the current market price. So please note, I am indeed following that convention. That convention is very testable. The following trades then occur. So I'm looking for a trade at or through 124. Ding, 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 ding. It didn't trade at, it traded through. So now this is a live limit order. The order has now been triggered, and now we have a live order. It didn't trade at, it traded through. Now we got to be careful about the next sequence, right? Because now the customer is saying that once we pull the trigger and turn this into a live limit order, he wants 123 or more. And so if the next trade is 122, he will not accept that, right? Because as a seller, he wants his price or more. If the next trade is 123.01, he will accept that. So we got to be a little more careful in these examples where we're pulling the trigger and it's not becoming a market order, where we're pulling the trigger and it's becoming a, in this case, a limit order. So you can have a stop that turns into a market order, or you can have a stop that turns into a limit order. So again, we have two versions of these stops. We have sell stops, we have buy stops. And whether you want a buy stop that turns into a buy stop that turns into a market order, or a buy stop that turns into a limit order, doesn't matter. A buy stop, whether it's a buy stop that turns into a market order or a buy stop that turns into a limit order, has to be placed above the current market price. So here we go. We sold short at 128. Now it's at 95, and we're placing a buy stop limit above the current market price. We got to be a little more careful now, because now when we're pulling the trigger, it's not becoming a market order, it's becoming a limit order. So same deal. We're going to show you a sequence of trades, and then you got to tell me on the exam, does it ever become a live order? Remember, one of your choices may be that it doesn't become live. All right, so we're going to look at the sequence of trades. We're looking for trade at or through 98. At or through 98. Ding, 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 ding. Now, remember here, he says he wants 98 or better. He's a buyer. So that means 98 or less. And so he won't accept that trade. So that's it. You tell me on the test that trade 5 is not his, right? Because he's saying if it trades at or through, I want my price or better. His price or better is, as a buyer, less. And so he would accept that. Maybe the next trade is 98.10. No, maybe the next trade is 97. Ding, ding, ding. He would accept that. So you got to be a little careful, a little more careful on these stops that turn into not market orders, but stops that turn into limit orders. By the way, that will be expressed to you. I mean, if they just say buy stop at 98, the assumption is it's a market order. If they say buy stop limit, that'd be spelled out on the exam. Boy, this is worth a lot of points on your exam. A lot of points on your exam. This mnemonic about where we place orders in relationship to the current market price. And we put buy limits below the market, and we place sell stops. And remember, whether it's a sell stop that you want to turn into a market order or a sell stop that you want to turn into a limit order, doesn't matter. Those get placed below the market. I think a great mnemonic worth a lot of points. I don't know if you're going to do a data dump on your exam. A data dump is, if I told you could have one sheet of paper with anything on it, front and back, what would be on there? And boy, that mnemonic BLiSS is worth a lot of points. BLiSS, buy limits and sell stops. Where do we place orders in relationship to the current market price? Now, I'm kind of lazy. So what I mean by that is I'm not going to remember SLoBS. Some people like SLoBS about above the market. I just know it isn't part of BLiSS. It's on the other side. But for those of you who want to have the other mnemonic, that would be SLoBS, sell limits and buy stops. And whether you want a buy stop that turns into a market order or a buy stop that turns into a limit order, those go above the current market price. So BLiSS and SLoBS, very important. That mnemonic's worth a lot of points. If you had one sheet of paper, a data dump sheet, maybe I have my options matrix on there. Maybe I have BLiSS and SLoBS on there. Very important. Now, we do adjust. Let's make another note here just about a test issue. You wouldn't want to have your buy limit triggered because of the X date. And so we are going to adjust orders below the market. For cash dividends. Because what's going to happen on the X date is the stock is going to go down, and you wouldn't want your order to be triggered as a result of that. Yeah, I don't like that. Let me fix that. I'll put it down here. We adjust orders for cash dividends that are below the market. Now, if I'm traveling a lot, perhaps maybe I don't want to keep track of that. I could tell you DNR, and that would mean that I know you're normally going to do that, but that means do not reduce. So if you're a customer, you don't want us to do that, then you need to tell us do not reduce DNR. That does not stand for do not resuscitate. That means do not reduce the order for cash dividends. So I would also know that as well. That's a test issue. Separate issue. I'm, not in this lecture, but remember the X date is the first date on which the stock no longer trades with the dividend attached. And so, it's going to go down. If it's Apple and they trade play a $2 dividend, if it closed at 128, it should open up at 126. And so we don't want these orders to get accidentally triggered, is the point here. Now let's clean up our slides here. Very, very important on the exam to know what constitutes taking discretion. Does your broker, does a third party have trading authorization on your account? I was watching a show on PBS that had nothing to do with our business. They were following a rookie in the NFL, and they asked him, does he have any advice for the rookie? The rookie went in this bistro, and there was a retired NFL player. And he said out of the blue, he said, never give your broker full trading authorization. I don't say anything. So apparently one of the athletes on the team had retired and when he got a Series 7, became a broker. And then he went back to his teammates and said, listen, if anybody understands the financial problems indigenous to being a high income producing professional athlete, it's moi. And if you give me full trading authorization on your account, not only will I be able to, handle those problems that are financial, indigenous being a high income producing professional athlete, I can also, pay your bills for you. Ooh. So, there's two versions here of a discretionary account where I have limited trading authorization. I can make a decision about action, asset, amount. I think a good way to remember this is the 3 A's, action, asset, amount. Our full trading authorization, we're not only going to make decisions about investments, but then I can withdraw monies and securities. And so full trading authorization would be even more of a challenge. And so you can't make a decision about action, asset, or amount unless you have a discretionary account. Your managers approve that, and there's all kinds of other rules about that in terms of types of customer accounts. Now, what we got to be able to do in our exam is recognize whether the order does require that I have discretionary authority to accept it, or can I accept the order from the customer? Time and price is called execution. And as your broker, I don't need to have on your account discretionary authority, trading authorization to make a decision about time and price. I mean, that happens all day long. I say, hey, buy 10,000 shares of GE today at whatever time and price you think looks good. Buy 10,000 shares of GE. That's an acceptable order. So very important to know what constitutes taking discretion. Let me give you an example of that as a question. This is a question that I wrote to just kind of illustrate this. And I think it's a good example of what you may encounter on your exam. So here's a question. So what of these orders can best be described as a discretionary order? So again, what we're going to use is our 3 A's. We're going to go through each of these orders and see if the 3 A's are present. If the 3 A's are present, it's an acceptable order. Now, you may be foolish to accept it, but it's acceptable. If you're my broker, you do not have discretionary authority on my account. I say, listen, I'm going to be in Mindanao in the Philippines. I may not make it back alive. There's 1,000 shares of GE in my account. If it looks like it's going to drop dramatically, sell it. That'd be foolish to take that. I mean, you would say, Dean, what about a sell stop or put or just sell the stock? But, the action, asset, amount are present. So let's go through this and look at this. So I'm looking for the 3 A's. So there's sell, there's action, 500 shares, there's the amount, Facebook, there's the asset. That is an acceptable order. That is not discretionary, meaning I don't need discretionary authority to accept that order for you. You say, Dean, work it for me, give me some good execution. So let's look at our next one. Again, we're going to use the 3 A's to get this right. So buy, there's the action. 100,000, there's the amount. Netflix, there's the asset. 3 A's are present. That's an acceptable order. Let's see, action. There's the amount. There's the asset. That's an acceptable order. There's the action. There's the amount, but what is missing? You would tell me on your exam that is a discretionary order that cannot be accepted by a broker or third party that doesn't have trading authorization. If I have trading authorization, I'm allowed to make investment decisions for you. But without that, that's a discretionary order. So very test will recognize a discretionary order. Now, another example of this that shows up on your exam quite a bit is a market not held order. Now, I left the secondary market lecture talking about New York. You know, you can always go back and to that video, and you can, I don't know, last 10 minutes or so, I started talking about New York, and I said, hey, when I do types of orders and I do that lecture, we'll revisit this. But we said in that lecture, still testable, that the New York Stock Exchange can best be characterized as an auction order driven market, an auction order driven market. And we said it's a double auction. There's buyers and there's sellers. And we said in that lecture, there's a person called a designated market maker. So that also known as a specialist. The other participant we have in that auction is a floor broker. Test question, a floor broker executes orders for clients of member firms. A floor broker executes orders for clients of member firms. So if I tell you that I'm the floor broker for Merrill Lynch, for example, that means I'm the one who's responsible for executing orders for clients of Merrill Lynch. And so maybe I tell my Merrill Lynch floor broker, buy me 5,000 baby Berkshire market not held. Now, if you're not clear what baby Berkshire is, maybe you have to say, Dean, what are you talking about? Now, the baby Berkshires are the Class B stock in Berkshire Hathaway. So let's see, action, amount, asset. So test question, does it require a floor broker to have discretionary authority to accept a market not held order? The answer is no. And so that's another way we test you on that, because in a market not held order, by the way, the other test question is who has the market not held order? Who has the market not held order? Who's holding it? It's the floor broker. So a couple test questions here. Right, so market not held. I mean, what we mean by that is he's going to take this order into the auction and the buyers and sellers, nobody knows he has the order. Bam, he does it whatever time and price he thinks looks best. That's what market not held means. The rest of the market doesn't know that my floor broker is holding the order. And it gives them the opportunity to work it for me and try and get me a good fill in terms of time and price. So let's just review the test questions here. I would definitely know, like A, B, C, D, who does what. If they say, which of the following participants on the New York Stock Exchange executes orders for customers of member firms, floor broker. If I say, which of the following participants would be holding a market not held order? And you'd say a floor broker. And then it says, does a floor broker does a not held order, is that a discretionary order? And you would say no, because remember, the action, asset, and amount are present. If those are present, remember we said time and price doesn't mean you need discretion. And what I'm trying to do there is give him some freedom to execute that order for me. Now, depending on who my floor broker is, will depend on whether that's a good idea or not. All right, so here's an example of the baby Berkshires of the Class B stock. This is the cheaper version of the Berkshire Hathaway stock. Who cares? But Berkshire Hathaway trades on the New York Stock Exchange, and we said there's a designated market maker. And so as you recall, maybe you don't recall, maybe you haven't watched the secondary market lecture, I try and give some thought, and I hope you as a participant do as well. I try to have a sequential sense that makes sense to these lectures. Not always. I mean, not always, but, I'm not following anybody's books or anything. I'm just trying to give you separate standalone lectures on these issues that you can use to confirm, when you're reading the book and you're doing your practice questions. So kind of the idea here. But anyways, we said the New York Stock Exchange has a designated market maker, AKA a specialist. And remember, he's supposed to conduct the auction. And there's those buyers and sellers in this auction place. And then, I gave you the example of 1792 when the New York Stock Exchange got started. I said, listen, guys, I'm going to specialize in Berkshire Hathaway, the Class B stock. You can floor brokers leave your limit orders with me. And if I can get your customer, their price or better, I'll do so. And so if you say, Dean, what's going on in the auction right now with New York? I said, right now in the auction, the highest bid is 238.91. And the lowest ask is 238.99, 5 by 2. Now, remember, this quote that we're looking at is not from market makers. This is the buy limit that the specialist is holding, and this is the sell limits the specialist is holding. And so if you want to give me a limit order and be competitive, I wish other businesses were like ours. I hate lines. I mean, it looks like if there's 10 muffins in the case and I'm the 11th guy, that I'm not getting a muffin. That may or may not be true. In our business, I say, I see the muffins are $2, but how about $3? Come on up. And now the guy who's 10th is 11th. So the person who wants to go to the front line just has to have a better price. People don't understand our market sometimes. I was on my way from San Francisco to Reno, and it was snowing, and I knew there'd be a guy at the top of the mountain air range that would put the chains on the car for me, because God knows I don't want to mess with it. Anyways, when I pulled into the queue to, the line to get the chains put on, there was somebody who was chewing this guy out about what he's charging to put on chains and all this kind of stuff. And anyways, I said to him, listen, I'm kind of in a hurry. In fact, I'm glad you're here. And how about I give you an extra $20 to jump the queue, jump the line? I go, yeah, come on up. And then that person got even madder. And they said, oh, and I said, listen, this isn't a regulated kind of thing. And I said, listen, that's why I keep the economy rolling. I agree not to chain up my own car, and he agrees not to, teach Series 7. So anyway, so if you want to give me a buy limit and you want to be competitive, if I were your broker, you're not going to give me a market order, because remember, your market order, boom, you're buying at that price. If you want to give me a limit order and be competitive, it would be over here. And you say, Dean, I want to put in a limit order at $238.90. And I said, well, $238.90 is not competitive. It's not competitive because right now there's somebody who's willing to buy the stock Berkshire Hathaway at $238.91. So, that wouldn't show up in terms of the quote. But if you want to step ahead here, what you could do is you could say, I want to put in a buy limit at $238.92. And now you would have the inside, right? Because you're stepping ahead because you're willing to pay more. Same thing here on the sell limit. If you give me a sell limit and say you want to sell it at $239, I said, well, that's not competitive because there's somebody who's willing to sell at a lower price than you right now. So that order isn't going to be competitive right now. But if you want to go to the front of the line, maybe you say, Dean, I want to sell Berkshire Hathaway on a limit. Remember, not a market, because if you sell at the market, bam, you're over here. But if you're telling me you want to sell on a limit and you say, Dean, I want to sell on at $238.98, well, then you'd go to the front line because you'd be willing to sell it at a lower price, right? So these are limit orders that are determining the quote. That's the main test issue, by the way, is that the New York Stock Exchange can best be characterized as an auction limit order-driven market. And it's the buy limits and the sell limits that are determining this quote. Now, sometimes you might be pleasantly surprised. In the over-the-counter markets, you're never going to be pleasantly surprised. But this designated market maker is allowed right now to buy the Berkshire Hathaway Class B stock at anything better than that, and he can sell it at anything less than that. He's allowed to trade his own account within the inside quote or the inside market. And so what we mean by that is that you might be pleasantly surprised. So you're a seller at the market, and it looks as a seller at the market that's what you're going to receive, right? Because as a seller, we're matching you with a buyer. And it looks like you're going to sell with a market error at $238.91, but the specialist says, I'll buy it at $238.92. Now, if the person with that limit order complains about that, the specialist says, he goes, well, were you trading ahead of me? The designated market maker specialist says, yes, but I was willing to pay a penny more than you were. And that benefits the customer by narrowing the spread. So right now, the specialist can trade this anywhere between these two prices. Well, the way we say that is he can trade within the inside quote. Remember, that inside quote, the highest bid and lowest ask, is again not a function of market makers. It's a function of the limit orders that the customer is that the specialist is holding. The inside highest quote, remember, the highest bid and the lowest ask. So that should be familiar based on our secondary market discussion. But my point here is that the bid and the ask is not a function of market makers willing to buy or sell into their inventory. Here, it's a function of the limit orders that the specialist is holding. By the way, as I said, if you give me a buy limit that isn't competitive, you're not going to show up on the to the public market. You'll be on the specialist's order book, but it wouldn't actually show up, right? Because it's not competitive. So if you want to be competitive, you got to have a better price. 5x2, as you recall from the secondary stuff, So right now I say, if you're the customer, I'm the broker, you say, Dean, what's going on in the auction right now for Berkshire Hathaway, the baby Berks Class B? I said, right now in the auction, it's 238.91, 238.99, 5x2. That means there's 500 shares available at the bid, and there's 200 shares available at the ask. That's 5 round lots. A round lot is 100 shares. So that's the size. And then remember, this quote we're looking at is not a function of market makers. It's a function of the limit orders that the order book of the designated market maker. Now, remember, the other test question about this designated market maker is he's charged with maintaining a fair and orderly market. That too is very testable. He's supposed to maintain a continuous market. A continuous market. That means there's always going to be a buyer or a seller. And so that means if there's all sellers and no buyers, he's supposed to buy. And there's buyers and no sellers, he's supposed to sell. So I kind of joke, and now the order book is, public information, but in 1792, what's on the other side, that was my business and nobody else's. And, you think I might be able to make a pretty good living knowing where all the buyers and sellers are and at what price they want to buy and sell. Yeah, perhaps, right? Okay, so hang in there. We're almost done. I've been trying to get these lectures. I've made a conscious decision. Two reasons. One reason is I don't mind having longer lectures because unlike a class or something like that, you can always hit the pause button. There's a rewind button. And, when I decided I was going to on the YouTube channel start providing content, I see that a lot of people are providing, like little snippets of information. And so it's kind of like a novella, short story versus a novel. I've decided to try and have, I'll probably, when I get all the content up on the channel I want, I'll probably circle back and have snippets on, like, calculating parity on convertibles or, maintenance on a margin account, and just do it like that. I'll probably do that for 24, particularly because I don't want to put everything up there, but maybe a couple snippets. But for our purposes, mostly on the channel, I'm going to try and have a lecture theme and have a start and carry through the entire discussion. And so that means the lectures are a little longer than perhaps they would be if it was a snippet or it was a class or something like that. So, all right. So again, we're looking at the auction in Berkshire Hathaway Class B stock right now. And again, here's our bid, here's our ask. And so we have some additional qualifiers that are testable as well. Sometimes you can learn our language too well. I mean, if you've been doing our business for a long time, maybe go to Starbucks and say, I want to do an opening purchase. I want to go long event day. Yeah. I had a limo driver and he said, Dean, I'd like to troll around, find some more things. This is before Uber and Lyft, and, God bless them, because limo drivers are reliable till they're not. But anyways, I said, do whatever you want, but be back here at 10:30. The game's over. I want to go to my next venue. So, till then, do what you want. Anyways, 10:45, my phone rings and he says, Dean, I took a fare to the airport. It doesn't look like I'm going to be able to make it until 11. I said, fill or kill. I don't need a limo at 11. I need a limo now. Anyways, the owner of the limo called me. Did you threaten to kill my driver? I said, no, don't kill the driver, kill the order. Right? Before I retired here to Las Vegas, I used to sometimes, I had a mountain place and I would chaperone the boys' high school basketball team. If I pulled into McDonald's in the van and said 10 max, 10 fries, 10 shakes, fill or kill, that means I want it all. I want it now. If you can't fill me right now, I want no part of it. Kill it. Off the Burger King we go. If I said 10 max, 10 fries, 10 shakes, immediate or cancel, that means I'll accept partial execution. Here's 3 max, 2 fries, and a shake. If I say 10 max, 10 fries, 10 shakes, all or none, that means I'll pull the bus in the back. I'll wait till you to get it together. But don't give me 2 max, a fry, 2 more max, 3 more shakes. No, as we look at the quote here in the Berkshire, the baby Berkshires, if I give you an order to buy 1,000 shares, I'm going to get more than one report. Maybe they call me back and say, Dean, you got 200 at 238.99. You got another 300 at 239. And the last, what would that be? 300 at 241. Now, maybe I don't want to do that. I had a cluster mind named John, and he wanted to do something really silly. He wanted to buy 100 contracts with his option. I'm dating myself. He said, Dean, what would you do it for? I said, for me to run a ticket, John, cost me $40. That's my ticket charge with my clearing firm. So I'll do it for $40, but then I got to report that you got 20 contracts. I said, John, can I change the remaining 80 to 80 fill or kill? I don't want them doling these contracts out to us because, I'm going to start losing money. Can I change the remainder to 80 contracts, fill or kill? He said, well, Dean, aren't there some other things we could do? And I said, well, yeah, here we go, right? I said, well, we could do, 80 contracts, immediate or cancel. We'll accept partial execution. So what else is available? So now I had to walk them through this. But anyways, here's an example of a fill or kill. The customer says he wants to buy 300 shares. So remember now, what I'm going to do is I'm going to match him on the as a buyer with the seller. So we're looking over here, right? Because that's where the sellers are. And he's a buyer. And so he wants to buy 300 shares at $238.99. And I said, well, sorry, my friend, there's only 200 shares there. And so fill or kill, boom, it's a kill. It's a kill because he wanted it all. He wanted it now. So that order gets canceled and it gets killed. I fill or kill. All right, so let's look at our next one. Again, he's a buyer, so I'm going to match him over here with the seller. That's that sell limit over there. That's 200 shares, 2 round lots. And he says, Dean, I want to buy 300 shares at $238.99. Well, it looks like there's 200 shares available there. He said immediate or cancel. So he said he would accept partial execution. So he's going to get the 200 and the 100's canceled. P.S. that not testable, but that asking price will be in the next limit order over there at the next, lowest price, right? So whatever that is, that's how the new quote's going to look. All right, so he's going to buy 200. So again, this would be practical application on your exam to kind of see what's going to happen. Let's look at our last one here. All or none. He's a buyer. So again, I'm going to match him with the seller. It's a double auction. And he wants 300 and there's only 200, but he said he would wait. And so I tell him, well, we're waiting because there's not another, 100 shares there. Now, if all of a sudden somebody calls their broker and puts in a sell limit to for 100 shares at $238.99, that would go now there and he would get filled, right? Because if another 100 shows up at that price, now the size would be 5 by 3. All right, so those are some other qualifiers that you get tested on in your exam. That's more likely, by the way, Series 7 top off. I wouldn't worry about that at all on your SIE, and I wouldn't worry about that at all on your 65. So. Oh, okay. Well. All right. So I don't know when I'll put this up on the YouTube channel. Probably sometime. I'm trying to do 1 lecture a week, so that would mean this week this will go up at some point. Pending lectures that we still have that we'll be putting up there at some point are going to be multiple option strategies. I haven't done that yet. What else? I had another one. That primary markets, huge. Haven't done that one. So those are coming attractions. If you have any questions about the lecture, put it in the comment box under the video. Share and subscribe. You're more than welcome to share this resource with anybody you'd like. And I'll see you in the next lecture. If you have a general question about any exam, put that in the general comment box on the YouTube channel.